Sophia sends her rent on the first of the month. Same as always. Phone app. One tap. Done. $1,400 gone in about 2 seconds. She doesn't think about it much anymore. It's just the number that leaves before anything else does. Here's what she doesn't see happening on the other side of that same transaction. Her landlord takes a chunk of that $1,400 and pays down the mortgage principal on the building equity, month after month, using money that used to be Sophia's. Another chunk covers property tax and insurance, expenses that would exist either way, but that Sophia is functionally covering for someone else's asset. And whatever's left over is profit, pure profit, generated by Sophia continuing to exist somewhere and pay for the privilege. None of that is a scandal. It's just how renting works. But almost nobody actually sits down and looks at both sides of that transaction at once. This isn't a video telling you renting is always a mistake or that buying is always the smart move. It's a video about the part of the equation that stays invisible because you only ever see your half of it. Let me show you the math. My name is Alex, and I spend a genuinely unreasonable amount of time looking at where people's money quietly vanishes to, or in this case, where it quietly reappears somewhere else. If you've ever been told renting is throwing money away and weren't totally sure if that was true, hit subscribe, because today on Wealth Adjacent, we're taking apart both sides of the rent check. Before we go further, a quick disclaimer. I'm not a financial advisor. This isn't financial advice, and the honest answer to should I rent or buy is genuinely, unsatisfyingly, it depends. And anyone who tells you otherwise with total confidence is skipping steps. What I am here to do is show you the actual mechanics most people never look at, so you can run your own numbers instead of accepting a slogan. Let's introduce someone. Sophia, late 20s, works in healthcare administration, has been renting the same one bedroom for about 3 years. She's not being careless. She's actually a decent saver. She just assumed, the way most people assume, that owning was simply out of reach, did the mental math once, years ago, and never revisited it. Let's start with the number, because it is genuinely a little unhinged. On a typical mortgage payment, particularly in the early years, a meaningful share goes toward interest rather than equity, but a real and growing portion does go directly toward paying down principal, meaning the owner is building actual ownership stake with every payment. Let me say that again. Every month, a landlord with a mortgage on the property is using rental income to reduce their own debt and increase their own net worth, using money that came from someone who, at the end of that same year, owns exactly 0% more of anything. Where does the rest of that rent check actually go? A meaningful share covers property tax and insurance and maintenance, real costs that exist regardless of who lives there. Another share, especially in the early years of a mortgage, goes to interest, which the landlord can typically deduct as a business expense, an advantage renters simply don't have access to. And whatever remains after all of that is straightforward profit. Plus, the property is very likely appreciating in value the entire time, completely independent of the monthly rent check, adding to the landlord's net worth in a second, separate way. And here's the part that should make you sit up. Over a decade of renting, the actual cumulative dollars paid can add up to a genuinely enormous number, often well into 6 figures for a single person in a mid-cost city. And at the end of that decade, the renter owns precisely none of it, has built precisely zero equity, and has precisely zero asset to show for a decade of consistent, on-time payments. Meanwhile, the person on the other side of that transaction has spent the same decade converting those payments into an appreciating asset with a shrinking mortgage balance. There's a broader wealth gap pattern worth naming here too. Survey data on household net worth consistently finds homeowners report meaningfully higher median net worth than renters of similar age and income, and a large share of that gap is attributable specifically to home equity rather than other investments. That statistic gets repeated constantly, and it's genuinely true, but it's also frequently misread. It doesn't prove owning causes wealth. It's partly survivorship. People who could already afford to buy tend to have more financial stability to begin with, and it's partly the simple fact that a mortgage is a form of forced, automatic saving that most renters never replicate voluntarily on their own. The gap is real, the causal story behind it is more complicated than the headline suggests. But that fact alone isn't the trap. That's just a fact about how renting works, and it's not automatically a bad deal, because owning carries its own real costs. Here's where it becomes a trap. A significant share of renters report they've never actually run a real, honest rent versus buy comparison for their specific situation. They've simply absorbed the general cultural message that renting is inferior without checking whether it's actually true for their city, their timeline, and their finances. And the genuinely uncomfortable stat sitting right next to it, a notable share of people who did buy, specifically because they felt pressured by the renting is throwing money away framing, ended up selling within just a few years, often at a loss once closing costs and market timing are factored in. Read that twice. People are being pushed toward ownership by guilt about renting into purchases that mathematically would have been better left as rent because the slogan skipped the part where timing and location actually matter. Back to Sophia. She ran the numbers for the first time in 3 years, genuinely, properly, for her specific city and situation. Renting her current place costs her about $1,600 a month all in. Buying a comparable place in her area after a realistic down payment, mortgage, property tax, insurance, and estimated maintenance would run closer to $2,200 a month, at least for the first several years, before principal paydown and appreciation started meaningfully closing that gap. In her specific market, at her specific price point, renting and investing the $600 difference actually came out ahead of buying for at least the next 5 to 7 years. That's not true everywhere. It happened to be true for her. She is not the exception in one specific way. Most people never actually check. Most renters, when they finally do run the real comparison for their own numbers instead of a national average, find the honest answer is more nuanced than either slogan, renting is throwing money away, or renting is always smarter, would have you believe. Now here's the part that turns this from a math problem into a psychology problem, and this is the part that should genuinely fascinate you once you see it clearly. Renting is throwing money away is a phrase engineered around loss aversion, the well-documented tendency to feel losses more intensely than equivalent gains. Framing rent as money that's simply gone, vanished, wasted, hits that loss aversion trigger hard, even when the actual comparison, once you include a mortgage's interest, taxes, insurance, maintenance, and the opportunity cost of a down payment sitting in that property instead of invested elsewhere, is genuinely closer than the slogan implies. A researcher studying framing effects in financial decisions found something almost too honest. People evaluate identical financial outcomes very differently depending on whether the framing emphasizes what's being lost versus what's being built, even when the underlying numbers are mathematically equivalent. Rent gets described as money leaving forever. A mortgage payment gets described as building equity. Both statements are true. Only one of them is designed to make you feel something specific about it. And then there's the specific mechanism that makes this framing so sticky. Homeownership has genuine, real cultural weight attached to it. Stability, adulthood, a marker of having made it, which means the rent versus buy question rarely gets evaluated as a purely financial decision. It gets tangled up with identity and self-worth, which is exactly the kind of emotional terrain where a catchy, simplified slogan does more work than an honest, complicated spreadsheet. Now, before we go further, we still haven't gotten to the layer of hidden costs that flips the math entirely once you actually account for them properly. Hold that thought, because first, the smaller pieces nobody mentions. Let's talk about the phrase that should trigger alarm bells the moment you hear it. Your mortgage payment is basically the same as rent. That phrase almost always excludes property tax, homeowner's insurance, private mortgage insurance if the down payment is under a certain threshold, and maintenance, which for an older home can easily run several $1,000s a year that a renter simply never has to think about because someone else is contractually responsible for the roof. Then there's the opportunity cost of the down payment itself, a genuinely large sum of money that, if it weren't tied up in a home, could have been invested and compounding the entire time. Multiple studies comparing renters who invest the difference against buyers find that in higher cost markets specifically, the renter investor frequently comes out ahead over a 10 to 15 year horizon, purely because the down payment and the monthly cost gap invested consistently compound faster than home equity typically appreciates in those specific markets. There's a transaction cost version of this that almost nobody accounts for either. Buying and selling a home each carries significant closing costs, commissions, fees, and taxes, often adding up to a meaningful percentage of the home's value on each end. Someone who buys and then needs to move within just a few years for a job, a relationship, any of the completely normal reasons people relocate, can lose money on the purchase even in a market where home values technically went up, simply because those transaction costs eat the gain. And then, the layer of hidden costs that genuinely flips the math, maintenance and repair costs on an owned home, are famously unpredictable and famously expensive. A failed water heater, a roof replacement, a foundation issue, costs that a renter's landlord absorbs entirely and a renter never even sees a bill for. Homeowners who track this honestly often find annual maintenance costs run into several $1,000s in an average year, a cost that's essentially invisible in most casual rent versus buy comparisons because it doesn't show up as a predictable monthly line item the way a mortgage payment does. It's also worth being honest about the landlord's side of this because it's not automatically an easy win either. Being a landlord carries real risk, vacancies where no rent comes in at all, tenants who damage a property or stop paying, and the same maintenance and repair costs a homeowner faces, except now spread across someone else's schedule and complaints. Being a landlord is a business with real downside, not a passive money machine that prints wealth with zero effort. That doesn't cancel out the math from earlier. The equity and appreciation genuinely do accrue to the owner over time. It just means quietly getting richer, understates how much active risk and work sits underneath that outcome for the landlord too. All right, here's the section nobody wants anywhere near a calculator when someone says renting is throwing money away. Let's do this through Sophia, because abstract numbers slide right off the brain. Take that $600 monthly gap between her rent and what buying would actually cost her, all in, and invest it in a simple index fund earning a conservative 8% instead. Left alone for 15 years, that $600 a month becomes roughly $208,000. Meanwhile, a comparable home in her market, growing at a realistic long-term appreciation rate after accounting for the costs we just walked through, would need to significantly outpace that pace of growth for buying to have actually won the comparison over that same period in her specific market. In a lot of markets, it does win. In Sophia's, over that specific time frame, it currently doesn't. Here's the framework I want you to carry around. The real comparison was never rent versus own as abstract categories. It's the total monthly cost of owning, including every hidden line item, versus rent plus what you'd actually do with the difference. Run for your specific city, your specific price point, and your specific timeline. Whoever wins that comparison for your numbers is the right choice. It's not a moral question, it's an arithmetic one. And now here's where it gets almost cruel. If owning reliably built more wealth than renting and investing in every market, at every price point, you could defend the slogan outright. It doesn't, uniformly. Research, comparing long-term wealth outcomes between renters who consistently invest the difference and owners finds, the result depends heavily on local price-to-rent ratios, meaning the same obvious advice that's true in one city can be flatly false in another, which is exactly why a national slogan can never actually be a reliable, individual answer. Now, let me keep my promise, because I am not telling anyone that renting is secretly always better. I can already hear the objections, because I get them every time I make a video like this. First, but owning gives me stability and control that renting never will. That's worth something beyond the math. Fair point, and genuinely correct. The ability to paint a wall, plant a garden, and not worry about a lease non-renewal has real, legitimate value that a spreadsheet doesn't fully capture. But notice the actual disagreement isn't with the math. It's a values question about how much that stability is worth to you personally, which is a completely fine reason to buy even if the pure numbers say renting wins, as long as you're making that trade knowingly. Second, but rent always goes up. At least a fixed mortgage payment stays the same. Also fair, and also worth naming honestly, a fixed-rate mortgage genuinely does provide long-term payment predictability. Rent doesn't, which is a real point in ownership's favor over a long enough horizon, particularly in markets with fast-rising rents. The actual answer was never renting is always smarter, or buying is always smarter. It's run your specific numbers before repeating either slogan as if it were universally true. There's a third point worth naming honestly too, one that cuts in ownership's favor. A mortgage functions as forced savings in a way that renting and investing the difference only works if you actually consistently do the investing part. Plenty of renters who could theoretically come out ahead never actually direct that monthly gap anywhere productive. It just gets absorbed into general spending instead. A mortgage doesn't give you that option. The payment happens whether you feel disciplined that month or not. The math genuinely favors renting and investing in real, common scenarios, but only for the renter who actually follows through on the second half of that plan. So here's the framework I'd actually use. I call it the full cost test, and you can run it on your own situation in about 10 minutes. Add up the true all-in monthly cost of owning in your area, mortgage, tax, insurance, and a realistic maintenance estimate, not just the mortgage payment alone. Compare that honestly to your actual rent. Take whatever gap exists and ask what that gap, invested instead, would become over the time frame you'd realistically stay in the home. If owning still wins after all of that, genuinely transparently, buy with confidence. If renting wins, you're not throwing money away. You're making the mathematically correct choice a buck can talk you out of considering. So here's where we land, clearly and honestly. The landlord isn't doing anything wrong by building wealth from your rent. That's simply what owning rental property does, and it's a completely legitimate business. The trap isn't that your landlord gets richer. The trap is believing that fact alone means you're automatically losing without ever actually running the comparison that would tell you whether, in your specific situation, renting and investing the difference might be the version of this story where you're the one quietly building wealth instead. And if you're Sophia right now, sending that same rent payment on the first of the month, hear this clearly. You're not throwing money away by definition. You went up against a slogan built for loss aversion, not for your specific numbers. Of course it felt true. It's designed to feel true regardless of the actual math underneath it. Seeing that clearly is most of the battle. So Sophia keeps renting for now, not out of resignation, but because she actually ran the numbers, and renting and investing genuinely wins in her market for her timeline today. She's set up an automatic transfer for that $600 gap, the exact same discipline a mortgage would have forced on her, except now it's compounding in an index fund instead of a single property in a market that isn't currently favoring buyers. Spend on the option that actually wins your specific math. Skip the guilt attached to a slogan that was never built for your city or your situation. And revisit the comparison every couple of years, because markets shift, and the answer that's true today isn't guaranteed to stay true forever. And the next time someone tells you that renting is throwing money away, ask them one question. Throwing it away compared to what, specifically in your market, over your timeline? If they can't answer that, they're repeating a slogan, not doing math. That one question alone will end most of these conversations faster than any spreadsheet could. If this helped, hit like, subscribe, and tell me in the comments, have you ever actually run the real rent versus buy numbers for your own situation? I'll see you in the next one.